financial decisions. So, wow, did that just go live now? I thought we were live already, and here I am talking. So, here we go again. Hey, everybody. It's time for your post market show. Be the boss of your money. It's your post market show. It's live. We go over the day's news, events, stock market analysis, etc., so that you could make the best possible financial decisions for yourself. So, let's get started. My name is Mitch Goldberg. Thank you so much for joining me. Stocks up again, continuing the trend that started 2 weeks ago. So we're in week three. Excuse me. We're at week three in a recovery. Are we still in a downtrend, or is the downtrend permanently broken and we are going to new highs? I see this is happening all over the place. All right. I see we're having trouble going to Facebook. All right. So if you're out there in Facebook land, hopefully you'll see me. And if not, what can I tell you? You'll watch it in the replay. So, so here I am hacking into the mic, but I've just had this horrible cold. I'm feeling a lot better, by the way, but I've just been having this cold. Markets go up today, and what we want to know is this like a real rally on our hands, or is this just a recovery from the last couple of days, last couple of weeks? You never know in the beginning of a rally if it's for real or not. For real. I mean, there's nothing that's phony about it. Just what we really mean when we say for rally or a downtrend is for real is, do we mean that it has enough power behind it to make it a longer lasting trend than just a short term blip in the charts? So that's one of the focuses today. But the Dow did finally turn around. So let's just take it to the tape real quick. Oh, that's not the one I wanted. This is the one I wanted. Okay. So the Dow is up 95 points. NASDAQ up 1.3%. That's a pretty big move. And you consider that the Dow and the S&P were up less than 1%. The Dow is barely up today. That's a pretty solid move. Gold is down. Oil is down a lot. Oil is down over 9%, as you can see. 10-year yield backed off a little bit. The VIX, okay, well, here we go. We talk about the VIX like literally every day here, down 1.18. And I keep saying if it gets below 20, we've got a rally in our hands. That's been a very consistent pattern. The VIX is below 20. So my sense that signals continued strength. So if you want to ask it in that way, is this rally real or not? I think the VIX below 20 tells you that at the very least, this is more than just a 1 or 2 week wonder. This is something that's got real power to it. So why? What the heck is going on here that makes this such a good rally? All right. There are a couple things going on. First of all, we're talking about so often for so long, the Fed's going to raise rates. The Fed's going to raise rates. So the Fed now is raising rates. Inflation is going to surge. Inflation is now surging. We've got a war, biggest land war in Europe since World War II. That's got to be terrible for the markets. It hurts supply chains. I'm talking from an economics perspective. Obviously, from a human toll, things are as bad as they get. But it hurts supply chains, hurts semiconductors, mining of products like neon and platinum. Products, materials that we need to make things like semiconductors and catalytic converters, etc. It's just another knock to the supply chain, which keeps inflation elevated. So what's really going on here then? How come we're having a rally? The short answer is, from everything I could see, what all the pundits are talking about, and I think this is pretty plausible, that even if we do go into an economic slowdown and the Fed keeps raising rates and inflation is too much, somehow we wind up tipping into a recession. The big stocks are telling us that a recession would probably be pretty shallow and not last that long. and we would come out of it pretty quickly. So the stock market investors, I should say, investors are already not only factoring in getting this potential recession past us, but investors are starting to factor in the recovery after that. We're just factoring in things that are further and further into the future. So that's the way I see it. Okay. Now there are a number of pundits that say we're heading into a recession, things are going to get really bad, and there's nothing that we could really do. Okay. So unfortunately or fortunately, I think it's still too tough to say. The bu- the fact is, if you're investing, if your whole retirement strategy and your investing plan, which is obviously a big part of your investing strategy of your retirement plan, investing is a huge. I'd say investing is a pretty big part of your retirement plan, right? Wouldn't you say so? There's more to it. I understand. And we'll talk about that, but we if your investing is based on some pundit in the media saying, I mean, besides me, of course, but if it's dependent on somebody saying we're going into recession, the market's going down, or the market's going up, and we're going to have this great bull market, I would tune all that out. I'm very comfortable saying to you that in a couple of years, the things we're talking about today probably are not going to matter that much. And when I say to you that there's more to a financial plan, a retirement plan than just investing, this is what I mean. When you have money you're putting aside for retirement, be it in a 401k plan, an IRA, Roth IRA, individual account, or a combination of all of those, it's not just the investing that counts. It's the consistently and being diligent about this, about putting money away into accounts, about automating that move. Like, so from your paycheck, it will automatically, once your paycheck hits your bank account, you'll automatically send, let's say, $500 a month into a brokerage account. And the nice thing is, if you're in a 401k plan, your money goes into your 401k plan, into your 401k before you even get the rest of the money from your paycheck. So that has a lot to do with it. Another thing that has a lot to do with it is to see the location of your money. Is it all in an IRA, all in a 401k, or is it spread out between different kinds of accounts? Because at different times in your life, there it will become more because at different times of your life, it will become more advantageous to withdraw funds from different kinds of accounts, either from an IRA, a Roth IRA, an individual stock, or an individual account, a taxable account. Remember, not everybody simply invests in only an IRA, or, in only a retirement plan. People just have a regular brokerage account that's not tax sheltered or tax favored as well. All right. So the other thing is we need to talk about now. I just want to talk about the here and now. Oil. Price of oil has down almost $10, which we just went over a moment ago. And when oil goes down, it changes the equation pretty rapidly. And you see companies that use oil, the stocks of companies that use oil, went up a lot today. Companies like UPS, airline stocks, all right? Obviously, energy companies went down today. Some of the biggest losers in the stock market today, I'm talking of large cap companies, were energy companies. And some of the biggest winners are companies that use oil. A couple of comments out there, so let's just pick those off right here. Got to stay committed to the process, long-term outlook. That says it all right there, Philly. It's if you don't have a process, then what are you doing? Get the process, stick with it. The process always looks like it could be improved or there's something wrong with it when the market's going down. That's why you have to stick with the process, okay? Decide what you're going to do in a down market, not necessarily just what you're going to do in an up market. And this way you'll have the staying power to follow through on your plan, on your process, okay? Most important criteria to answer your question is risk and time horizon. Oh, absolutely. In fact, your risk tolerance is determined by your time horizon. The longer you have to invest, the more risk you can take. It's a very simple equation. Semiconductors. We need government intervention here with the CHIPS Act. We can't continue to rely on Chinese chips. Well, absolutely. When I got into the industry in 1990, like 35% of all semiconductor chips globally were manufactured in the U.S. And now it's something like 15%. And we're dependent on our trading partners to supply us with chips. We're dependent on Taiwan, especially. If China invades Taiwan, which a lot of people think could happen, then what are we going to do for semiconductor chips? It's not like we could just manufacture them here just like that. It's a very big deal to create a semiconductor manufacturing plant. It takes time. I see a lot of recovery. Will travel stocks ever get a bounce? Well, I think travel stocks have already gotten a bounce, and then they bounce down and they bounce up. But I think that as you see oil go down and people start getting out, that's going to benefit travel and leisure, the travel and leisure industry. Um, is it factored in yet all the way? I couldn't tell you for sure. I'm not a travel and leisure expert. I am a diversified investor. And by the way, diversification is a strategy that we use to mitigate risk, but it doesn't generally protect your portfolio from going down in a generally down market. Having said that, I'm a very diversified kind of investor. Like when I buy stocks, individual stocks, I have industrials, but I have consumer staples, I have financials, I have tech, I have some energy. You see what I mean? I have some consumer discretionary. All right. I really spread my bets around. But first thing I do is I buy what I think is the best company in a sector. That's the first kind of thing. That's the first stock I'll buy in a particular sector. Now, if you want to take a shot on like a second tier bank stock or a company in the tech sector that almost no one has heard of, that's up to you. But before you do that, make sure you buy, in my opinion, a tech stock that is a very well regarded, well managed blue chip type company as well. So I would do that first before I buy the lower tier name. It's just my own thoughts. Okay. So let's take a look. What else? We went over the VIX. Okay. Let's take a look at crypto, because crypto, I don't know if you guys know this, but crypto is now up on the year. All right. So let's get to the world of crypto. Okay, let's pop myself in here. That's not what I wanted to do. Here we am. Okay. Here we are. All right. So Bitcoin up 7%, 40, almost 48,000. So it's slightly up for the year. All right. Ethereum over 3,400, up 7%. I remember that was just like 2,900, like a week ago. And a few of the others, Litecoin up to 131. Where's the Doge? I don't even know why I look at that. I'm just like, I still look at it. Where is Doge? There it is. Doge up up almost 8%, but it's only up a penny though. If you think about it, it's going to fluctuate a penny, but 15 cents. That was like 79 or 75 cents when Elon Musk touted it. This is why you have to be careful, who you listen to. All right. And then let's talk about this. Are we going into a recession? So this is the big question. Can the Federal Reserve engineer a soft landing by very gently raising interest rates on a gradual glide path and letting the bonds mature on its balance sheet, which is called letting them run off, and overall just affect higher rates, squelch inflation without throwing the economy into a recession and without unemployment rising? That's that's really the the $64 trillion question. And today and all last week, it felt like, yes, the Fed can engineer a soft landing, and maybe you won't even get a recession. The Fed doesn't necessarily have to cause a recession, but if you want to slow the economy down, can you slow the economy down just a little bit, but not go into a recession? Or is that asking too much of the Fed, whose instruments, whose tools are pretty blunt? These are very scattershot approaches. The Fed doesn't use a scalpel. The Fed uses a shotgun blast approach. All right. So JP Morgan's Kalanovic, I bring this up because When we were at the bottom of the recession, bear market, pandemic low in 2020, Kalanovic of JP Morgan came out and said, we're going right back up. And we talked about that on the show. So if you watch the show, we talked about it. I agreed with him. Okay. And he says US is unlikely to go into recession, even as the bond market flashes a warning. All right. So first of there's two things. Marco Kalanovic says probably not a recession. He's one of the best in the industry. And now let's talk about the yield curve, because you're hearing, oh, parts of the yield curve inverted. First of all, the yield curve is not inverted in the definition that we're used to that causes a recession. You've got the 2-year treasury, the 1-year treasury, right? You have a 10-year treasury, a 30-year treasury. We're going to focus right now on the 1-year, 10-year. We're going to focus on the 2-year, 10-year, 5-year, and 30-year treasuries. So that's 2, 5, 10, and 30-year treasuries. Okay. So if the 2-year treasury and the 10-year treasury is really considered the yield curve, you could say lots of different parts of the yield curve, but that's the thing that people pay attention to, the spread between the 2 and the 10. When the 10-year yield goes above the 10-year yield, that's what we call an inverted yield curve, meaning that banks pay you very low interest at, let's say, almost zero, and they then loan that money out for a higher yield. But at the 2-year and the 10-year, once short-term interest rates are higher than long-term interest rates, banks don't make any money lending. They actually lose money by lending because their cost of money is higher than what they could get for it by making loans. So banks pull back on loaning money, on lending money, and that is what causes a recession. It slows down, and in some cases almost stops the availability of credit of people and businesses' ability. It almost halts the ability of people, of consumers and businesses to borrow. And that's why the negative sloped yield curve is such a problem. Now, the 5-year has risen above the 30-year slightly. So people say, wow, that's a big difference. 5 to 30, 25-year difference. That's a really inverted yield curve. It's not that big of a deal, except that, someone in the media is dying to say, we have an inverted yield curve. Oh my God, it's inverted. Holy cow. We have to talk about this. This is the biggest thing since sliced bread. No, let's not overstate this. There are not a whole hell of a lot of interest rate products like 30-year mortgages and corporate bonds that are tied to the 30-year. The 10-year treasury, not the 30-year treasury, is what most market interest rates are tied to. So the difference between the 2-year and the 10-year is really what we need to look at. And that's not inverted. It's close to being flat, but it's not inverted yet. If it does invert, and I'm not talking for like a second, but if it stays inverted for, I'm not really sure what a good time frame is, let's say a couple of months, that typically signals a recession comes up in 6 to 12 months. And the yield curve is the undisputed champion of predicting recessions. But we're not quite there yet. So don't let anybody scare you with this negative yield curve. The 5 and the 30-year, these are not really the important parts of the yield curve. The 2-year and the 10-year are the important parts of the yield curve. Okay. Let's take a look at some sectors and some other interesting tidbits. All right. Industrials. See UPS up $4, American Airlines, CSX, UAL, FedEx. These are the companies that use oil, and they were up today. Okay. My friend Philly asked about travel and leisure stocks. So I call those reopening stocks. So let's take a look. Marriott is 171. Planet Fitness 84. These stocks are doing pretty good. All right. Southwest, we need to see that really rebound. But we had a big move up today in Delta. UAL, American Airlines, Royal Caribbean. Cinemark Holdings is not really in that class. Norwegian Cruise, Carnival. They've got a long way to go until they're at their highs, absolutely. But it was a very good day for travel and leisure. Good day for restaurant stocks. Oil. Where do people make up the high cost of oil when they have to pay a lot of money to fill up their gas tank? That means maybe they're not going to spend money on travel and leisure. That's basically what that means. Airline tickets, by the way, are a freaking fortune now. I'm just looking at airline tickets for a trip, and I'm like, my eyes are like what popped out of my head. I couldn't believe how expensive everything is. So let's take a quick look at which sectors held up best today, and I think we'll be able to call it a day momentarily. Sector ETFs, okay. Consumer discretion had a good day. Amazon had a good day. A lot of it has to do with that. Real estate was pretty good. Technology related, communications. What did poorly? Financials, building materials, and energy. The three of the four most sensitive sectors to the economy were down, and XLI was barely up. Industrials, financials, building materials, and energy are very economically sensitive, and they were flat to down. Energy was down quite a bit. Again, price of oil really went into the crapper today. So that's the story of the day. Let's see over here. Joanne, what's up? Hey, so nice to see you on the show. Encouraging forecast, Mitch. I know I can always look to you for honest and straightforward info. Oh, thank you so much, Joanne. Hold on a second. Mm, mm, mm. It's from the Wolf of Wall Street, right? Thank you, Joanne, very much for that wonderful compliment. All right, so that's my story. I'm sticking to it. I'm going to head out of here in a little bit, so I'm going to end the live stream. Keep the faith, stay diversified, think long term. This too shall pass, and stick to quality. All right, have yourselves a lovely rest of the day. I'll see you tomorrow. Thank you.